I've gone through and watched videos from legendary investors Bill Ackman, Cathie Wood, Warren Buffett, and more. And in this video, I'm going to give you their best tips for investing in a recession. We're kicking things off with Bill Ackman, a legendary hedge fund investor with a multi-billion-dollar net worth. And he says the best advice for investing in a recession is to look at company profiles, because companies that have high leverage rates are going to be the ones that do not survive. So look at those balance sheets, look at the free cash flow in a company. You can do all of this on a site like Yahoo Finance for free. Look at the bottom lines. Is there cash flow? Can they weather the storm? Are they increasing their revenue year after year? Maybe there's one or two blips there during a recessionary period where the revenue does not increase, but the rest of the time the cash flow should be increasing, and the amount of free cash flow in the company to weather the storm should also be strong and stable. Those companies survive. The ones that do not have these things get wiped away, and you should avoid investing in them if you can. Tip number 2, coming straight to you, is from Cathie Wood, the founder and CEO of ARK Invest. And what she says is that you have to have conviction built into your investments, otherwise you won't withstand the coming recession. You have to be able to defend your position when the stock market or the stock you're invested in does drop. And that comes from understanding those companies that you're invested in at a very, very high level of detail. There has to be some level of conviction. Otherwise, you're going to look to sell the stock when times get rough. You have to be able to ride out that wave and know that you've invested for a reason. In Cathie's example, she says she's investing mostly in innovative and disruptive companies, the new disruptors that are going to pave the way for technological advancements in the next 5 to 10 years. So if there's companies out there that you strongly believe in with a high level of conviction, those may be a good idea for you to invest in a recession, and just buy in and average in as the price slowly drops down if the stock price does sell off. Tip number 3 from Dave Ramsey, the financial radio host and personal finance guru that many of you probably know about. What he says is this: he likens investing in a recession to riding a roller coaster. And what he says is you want to invest and hold long term. Those that get off in the middle of a roller coaster ride, you can imagine what's going to happen. It's not going to be good for them. The same thing applies to investing in stocks in a recession. The roller coaster is going to go up, it's going to come back down. And if you don't get off the ride, I mean, if you don't sell your position that you believe in, you're going to be just fine on the other end when it goes back up that next loop. It goes in cycles, Ramsey says, and you have to be understanding of that and not freak out looking at your 401k or your TFSA every other day, seeing how the value has changed. Think about it in long terms, enjoy the ride, and don't get off the roller coaster when you're going downhill. Moving on to tip number 4 from Ray Dalio, hedge fund billionaire with a net worth of $15 billion. What he says is pay attention to cash in a time of a recession. This is why. We get to a recession normally after a series of interest rate adjustments, as we've seen in 2023. These rates affect people in a negative way, reducing the amount of cash flow in the system. This leads to a sell-off in the stock market, things like cryptocurrencies, and other somewhat volatile returns. On the other side, though, it leads to a more stable or bump up, even an increase in returns in things like cash, GICs, and bonds. So what Ray Dalio's advice is to pay attention to those alternative types of investments out there and not just discredit cash as a waste of time. If you can stockpile enough big old bag, you can back up the Brinks truck when things do start to recover and get into positions at a much more attractive price relative to where the stock market sell-off began by hoarding cash in times of uncertainty. And last but certainly not least, Mr. Warren Buffett, the OG investor himself, his advice to us is this: always be buying. Average into your positions when they're going up, when they're coming back down. It does not matter when you're taking the long-term approach to the end game. Just keep buying in small increments along the way, and don't worry about riding the wave up, timing it perfectly. You can't really do that yourself that well compared to the hedge funds out there. So if you just average in all the time consistently, it'll be much easier for you to do this, less time involved, and a better return long-term without having to guess or try and time the market. So I'm going to ask you the question, which one of these 5 tips really hit home with you? For myself personally, I was very surprised by Ray Dalio's comments about not discrediting cash. To me, cash has always been a losing position, but it made me think about it, at least in a different way, that maybe there's a point in time when cash is actually a good thing to have. But I'm very excited to see what you come up with and what your favorite point of the 5 was. My name is Andrew Ferguson. Thank you again for watching. I will see you on the next one.